because the reason why I really dived into property back in the day, Jake, was that I understand people are going to live on their superannuation, but again, around about 91% of this population are not going to have enough superannuation to live on when they retire. There's a high percentage of people going to run out of money 5 to 7 years after they retire, because here's what they don't understand about super. Number one, you can't control the stock market. You can't control economies. You can't control the companies in the stock market, and you can't control world events. Have a look what happened recently when Trump introduced the trade tariffs. The market dropped 20, 30%. You had, the GFC had dropped 30, 40%. You had, the buildings getting hit in 2001, dropped 40% overnight. I mean, there's no control as an individual. You can't control your money that's in a superannuation fund because it's predominantly in the stock market, right? But I can control real estate, and I can build real estate, and I can add value to real estate, and I can subdivide, and I can renovate. There's a whole range of things I can do. And, the majority of people are going to get caught out with just paying off their house and having some super. They're going to be around, 500,000 plus short of what they need to live on, because the thing they miss is this. They sit there today and go, oh, look, I'm nearly 50. I'm going to retire in 15 years. And my super statement says I'll probably have $600,000 to live on, right? What they're not doing is thinking about, hang on a minute, 15 years from today in Australia, on average, CPI and inflation doubles every 14 to 15 years. So if you want to live on $1,000 a week in today's money, 15 years from today, you're going to need $2,000. So your $600,000 that you projected to have for your retirement is going to be worth $300,000, right?
Yeah.
So you want to live on $2,000 a week, you're out of money in about 5 years. And if there's a stock market crash or something crazy happens at the time, and that's all you've got all your eggs in one basket, you're a sitting duck, and you're going to get screwed. And I've been telling people this for 20 odd years.
Yeah, it's scary, isn't it? This is a great topic, in that people don't ask, what's my purchasing power? And the system that we were born into it's clever in that the metric we measure value in, i.e. dollars or pounds or euros, it's actually disintegrating in value. So when something looks like it's going up in value, either price is going up, it's actually that denominator is decreasing in value because they're putting more dollars into the system, more euros into the system. And when you look at your retirement pension pot, so a superannuation, for anyone that's not in Australia, is a pension. It's for your retirement. You're absolutely right. They're not going, okay, what's my purchasing power today? Well, what do I need it to be in 15 years' time? Okay, well, let's figure out that $600,000 today is actually the equivalent of the median house in Sydney. Great. In 15 years' time, $600,000 is not going to be the median price of a house in Sydney. And that's just the housing market as a metric. Like, what's the gold price going to do in comparison in 15 years' time? What's the Bitcoin price going to do in 15 years' time? And so as investors, that's essentially what we're doing every day, which is, what is the opportunity cost of not owning different stuff?